Welcome back, traders. In today's video, we'll be diving deep into two of the most powerful reversal candlestick patterns, the evening star and the morning star. These patterns are essential for identifying potential reversals in the Forex market. And by the end of this video, you will be able to know what these patterns are, the psychology behind their formation, how to find them in the chart, and how to trade them effectively in a live chart. Before we dive into the technical details of the evening star and morning star patterns, it's essential to understand their historical context and see how they have played out in real-world scenarios. These patterns have been observed and utilized by traders for decades, proving their reliability and effectiveness over time. Let's take a step back in history. One of the most notable instances of the morning star pattern occurred during the financial crisis of 2008. As markets plummeted, astute traders who identified the morning star pattern on various stock charts were able to predict the subsequent recovery phases, allowing them to make strategic entry points and benefit from the market's rebound. Similarly, the evening star pattern has been a critical tool for traders during periods of market exuberance. For example, during the dot-com bubble in the late 1990s, the evening star pattern frequently appeared on the charts of overvalued tech stocks, signaling impending downturns. Traders who heeded these warnings were able to exit positions before significant losses occurred. By examining these historical instances, we can appreciate the significance of these patterns and their ability to provide foresight in volatile market conditions. Now that we've explored the historical context and real-world examples of the evening star, it's time to shift our focus to explaining what these patterns are in Forex. What is the evening star pattern? The evening star is a bearish reversal pattern that appears at the peak of an uptrend, signaling a potential shift to a downtrend, and it comprises of three candles. The first candle, which is a strong bullish candle that reflects existing upward momentum, followed by the second candle, a small-bodied candle and can be a spinning top or doji, showing indecision in the market and signaling potential exhaustion of buying pressure, and the third candle, a bearish candle that closes deep into the body of the first candle, confirming the reversal. What is the market psychology behind these candle formation? The first candle reflects bullish dominance. The second candle shows hesitation or indecision as buyers and sellers reach equilibrium. And the third candle represents sellers gaining control and a shift in sentiment. Moving on. What is the morning star pattern? The morning star is a bullish reversal pattern that appears at the bottom of a downtrend, signaling a potential upward trend, and comprises of three candlesticks. The first candle, which is a strong bearish candle indicating downward momentum, followed by a second candle, which is a small-bodied candle that can either be a doji or spinning top candlestick, showing indecision in the market. A gap down signals potential selling exhaustion, and a third candle, which is a strong bullish candle that closes well into the body of the first candle, confirming the reversal. What is the market psychology behind the morning star formation? The first candle shows strong selling pressure. The second candle indicates hesitation as sellers begin to lose momentum, and the third candle reflects renewed buying interest, signaling a shift to bullish sentiment. How do we identify the evening star pattern and morning star pattern? First, the location of the pattern is crucial. For the evening star, look for it at the end of an uptrend. Conversely, the morning star should be spotted at the end of a downtrend, as these positions indicate potential turning points in the market. Secondly, pay attention to the gap between the first and second candles. While gaps are less common in Forex due to 24/5 trading, the small body of the second candle and the transition it represents are critical. This small-bodied candle, often referred to as a star, shows indecision in the market and sets the stage for a potential reversal. And thirdly, the strength of the third candle is vital. For the evening star, a strong bearish close that penetrates deep into the body of the first bullish candle confirms the pattern, while for the morning star, a strong bullish close into the body of the first bearish candle is necessary for validation. As the third candle signifies the shift in market momentum, it's important to note that these patterns are most reliable on higher time frames such as 1 hour, 4 hours, and daily charts, as lower time frames may produce false signals due to market noise, so focusing on higher time frames can provide more dependable insights. By understanding these key features and knowing where to look, traders can effectively identify the evening star and morning star patterns on Forex charts. This can greatly enhance their ability to anticipate market movements and make more informed trading decisions. Now that we've learned how to identify the evening star and morning star patterns on Forex charts, let's move on to how to trade these patterns step by step before going on a live chart. This practical approach will help you turn your analysis into actionable trades. Step 1. Identify the pattern in a key area. Use support and resistance levels or supply and demand zones to spot potential reversal areas. Confirm the pattern is forming at a logical reversal point, such as a previous swing high-low, or a Fibonacci retracement level. This ensures that the pattern is more likely to result in a meaningful reversal. Step 2. Wait for confirmation. Confirmation comes from the third candle breaking below the midpoint of the first candle in the case of an evening star, or above it in the case of a morning star. Avoid entering based on the second candle alone, as it represents indecision and may lead to false signals. Step 3. Entry point. For conservative traders, wait for the third candle to close and enter on the break of its low, for an evening star and high for a morning star. Aggressive traders might enter after the second candle if other indicators, such as RSI divergence or moving averages, support the reversal, though I advise against this approach. Step 4. Set stop loss. Place your stop loss above the high of the evening star or below the low of the morning star. For added safety, incorporate a buffer of a few pips to account for market volatility. Step 5. Target profit. Use key support or resistance levels as your first profit target. Apply a risk-to-reward ratio of at least 1:2 to ensure that your potential gains outweigh your risks. Consider using a trailing stop to capture extended moves and maximize your profits. By following these steps, you can effectively trade the evening star and morning star patterns, turning your analysis into profitable trades. Up next, we'll delve deeper into how to trade these patterns on live charts. Now let's see these patterns in action with some live chart examples. First up, we have the EUR-USD 1-hour time frame. Here, the price is trending bullish, approaching a resistance level. We see a strong rejection followed by a bearish candle, forming a perfect evening star pattern. This is our signal to go short. Place your stop a few pips above the pattern and target the next support level. Remember, in the Forex market, you don't need big moves to be profitable. A risk-to-reward ratio of 1:2 or 1:3 is often sufficient. Personally, I like to place my entry 20% to 50% or 80% of the third candle, depending on its size, to reduce risk. So we set a sell limit and let the market play out. And now we are in the trade, and we stay active to manage our open positions, not just letting it run and hopes it plays out as many beginner traders would do. Take day trading as any other business and manage your open positions by securing partials when necessary and letting the rest run to TP in order to build your tolerance gradually. As expected, our take profit is hit, and we move on to the next trade. Next, let's look at gold USD on the 1-hour time frame. Here, the market is in a bearish trend and reaches a support level. An evening star pattern forms, signaling a long opportunity. Again, we set a limit at 20% to 50% of the third candle to minimize risk and watch the market unfold. And now we are in the trade. We manage our open positions respectively. Our take profit is hit once more. Finally, a word of caution. Avoid overtrading. Not every evening or morning star is tradable. Focus on high probability setups at key levels to maximize your success. Understanding these pitfalls can save you from unnecessary losses and improve your overall trading strategy. One of the most common mistakes is jumping into a trade without proper confirmation. Just because you spot an evening star or morning star pattern doesn't mean it's a guaranteed reversal. Always look for additional confirmation through other technical indicators like volume, moving averages, or trend lines. This extra layer of validation can significantly increase the probability of a successful trade. Another mistake is ignoring the broader market context. These patterns are most effective when they appear at key support or resistance levels. Trading them in the middle of a range or without considering the overall market trend can lead to false signals and poor trading decisions. Over-leveraging is another pitfall to watch out for. While these patterns can be powerful, they are not foolproof. Using excessive leverage can amplify your losses if the trade goes against you. Always manage your risk by setting appropriate stop-loss levels and using a sensible amount of leverage. Focus on high-probability setups and be selective with your trades. Quality over quantity is the key to long-term success in Forex trading. By being mindful of these common mistakes, you'll be better equipped to trade these patterns effectively and enhance your trading performance. If this video have been helpful, please hit the subscribe button for more educational videos, and remember, no pattern is foolproof. Even the most reliable patterns can fail, and the market can be unpredictable. It's crucial to stay disciplined and patient. Avoid the temptation to overtrade or chase losses. Stick to your trading plan and trust your analysis. Over time, this disciplined approach will help you become a more successful trader. From DemarkFX, happy trading!